Hello, everybody, and welcome to Economics with the Honorable David M. Walker. I'm your host, Nick Palavita, and today we have some very exciting group plus some exciting topics to discuss, especially relating to the economy. So first of all, let's bring our panelist. And this gentleman has a law degree from the University of Miami and also a master's in business administration from NYU, formerly working on Wall Street and now co-host of Modern Investing on the IBM TV network. Let's bring in the Honorable Peter Bennett. Peter, welcome to the show.
Hey, Nick.
We're going to have some exciting topics to discuss today,
Absolutely.
especially relating to the economy. And this person, provided he can hear me, is actually a retired dentist, the famous author of the Monday Morning Millionaire. Let's bring in Milan Sombroric. Milan, welcome to the show. Hopefully you can hear us.
I can hear you now, and it's an honor and pleasure to be with a distinguished group such as this one.
Wow. Okay. Well, it's good that you can hear us. So technology does work. And when it does work, it's really great. And speaking about technology, this person is actually a professor at the Massachusetts Institute of Technology, otherwise known as MIT, the Sloan School of Business. And formerly, he was the president of Fidelity Investments and also the chairman of MFS, which is the largest and one of the largest, oldest mutual funds in the world. Let's bring in our special guest for today, Bob Posen. Bob, welcome to the show.
Thank you for having me.
Yeah. Well, we have a lot of great topics to discuss today. And can you tell our audience, since you're new to the network, although the network's pretty old, 2 years old, 2 months on all these different bands, tell us a little about yourself, who you are, where you're from, what you do.
Well, I teach, the last 10 years I've been teaching at MIT. I teach a course on financial innovation and corporate governance, and I wrote a book on personal productivity, and I teach a course to executives through our executive ed program. I came to MIT after many years in the investment industry. I was president of Fidelity when it went from 500 billion under management to $1 trillion. I then was in a number of government positions, including serving on the President's Social Security Commission. And then I went back into the industry when MFS had a set of problems, and we did a turnaround in 2004 and tripled its assets by the time I left in 2011. I've been writing on Social Security and on financial innovation and on many topics like the federal policies on mortgage-backed securities and other things.
Okay.
Excuse me. Perhaps Professor Posen could add that in the world ranking of universities, MIT is #1.
Oh, that's good. That's because they have a lot of smart people. All I know is the acceptance rate is like 7%. So 93% of you apply. Forget it. You're not going to go to MIT. My grandson wants to go to MIT. So I said, okay, that's great, but just realize they don't have a big acceptance rate. Now, speaking of something that we are having to accept is this thing called inflation. So, Bob, we're going to start with you. What are the causes of inflation, and what are your thoughts relating to inflation? It's now over 8% in the United States and also hits our worldwide audience.
The causes are twofold. One is we've increased demand. The government, in order to help people in the pandemic, gave out a number of grants and gave money to municipalities and other things. So and then the Fed flooded the system with liquidity by buying lots of mortgage-backed securities and treasury bonds. At the same time, we had a lot of supply problems, and they've continued. And then, of course, we had the Ukrainian war, which we still have, which drives up energy prices. So the combination of lots of liquidity on the demand side and bottlenecks on the supply side is what's driven up inflation. Now, unfortunately, the Fed was pretty slow to respond. Even last summer, when housing market in the U.S. was red hot. They were still buying mortgage-backed securities, and they were slow in raising rates. Recently, they've raised rates several times, and last week they raised it by 3/4 of a point, which was really dramatic. And I'm hopeful because of that, that the Fed is now getting up to speed. They were behind the curve, and now hopefully they're getting up to speed. But and the Fed will continue to raise rates, and they're also going to stop buying mortgage-backed securities and treasuries and shrink their balance sheet. So the real question is, are we going to go into a recession in order to change inflation expectations? And I think that's really a difficult question, but I would say that the chances of a recession are about 50% now because expectations have started to become embedded, and the Fed's going to have to react pretty dramatically in order to change that. But I'm hopeful that the recession will be mild because consumers still have a lot of cash. The unemployment rate is low at 3.8%. So even if it jumps by 2% to 5.8%, still would be reasonable. And financial institutions are pretty well capitalized. So those are all factors that point toward a mild recession. But the big question mark is the Ukrainian war, which could go on for a long time and has an obvious, a tremendous impact on energy prices. And so I would have to say that the US is actually in a much better position than Europe. And Europe, chances of recession, I would rate higher than 50%. So I think that's the big question mark. And we're all going to have to uh, deal with that. Unfortunately, I think the Ukrainian war could go on for quite a long time, and that's sort of uh, an overhang. Uh, so let me stop there, and I'll be glad to have conversations with other people on the subject.
Okay, well, we'll bring in Shaquille from down under, the president of the Pacific Rim Council in Australia. What are your thoughts, Shaquille, when it comes to this inflation?
Well, I think the two primary causes would be the massive amount of liquidity that's in the system, not just in the United States, but in most major economies in the world, coupled with an energy crisis, which I think is exacerbated by the push to green energy. Green energy in the long term will be able to bring down costs when they get it right, but they don't have it right yet. And I think that the lack of supply in oil is certainly going to cause a huge issue, and that high energy prices are going to affect everything from heating homes to supply chain issues where the cost of supply becomes dramatically more expensive. I probably disagree a little bit with you, Bob, on the employment rate. Yes, the employment rate is low, but the labour participation rate is not as high as it should be either. So I think that the tailwinds for the United States is probably going to be a little bit higher. But the US isn't going to have a choice. The Fed is going to have to increase interest rates because interest rates in most other major economies are rising. And if you don't get inflation under control, my fear is that you'd end up in a position like Japan has got. Japan's inflation rate is relatively good at the moment, 2.5%, but they have a contracting economy. So I think the United States really has to look at where they're going to be in the future. There is a weakening of the US dollar, both in strength but also in attractiveness for other countries. So I think that's going to be things that are going to affect the US quite substantially over the coming years.
Okay, well, we'll go to Sasha Starr from Canada. What are your thoughts ahead of our show, Modern Investing, this inflation?
Yeah, okay. I agree with Bob on many points, including his observation that the war in Ukraine will be a long one. The reason for that is being that as much as Ukrainians want to defend their country, their territory, and kick out all the Russian aggressors, the same way Putin is determined to win this war and make Ukraine the part of Russia, or essentially he's just basically destroying the country, and he makes an example to other countries, whether it's Moldova or Baltic republics or even Poland. Look at how we fight. We're destroying cities, we're destroying hospitals, schools, and killing everything alive, including women, children, and so on. So that war would have to be finished by one side prevailing decisively over the other side. And Russians cannot win that. They don't have enough, basically, arms to a lesser degree, but manpower is to a larger degree. Now, Ukraine have enough manpower, but they're waiting until complete course of bringing the U.S.-produced highly effective weapons will take its course, and it's not an easy operation. They have to be assembled, they have to be delivered to Europe, they have to be delivered from Europe to Ukraine on the front lines. They have to train soldiers, because essentially US and the West are creating a new NATO-like army in Ukraine. And if they succeed, there is no doubt that Ukraine will prevail in this war. If not, then Russia will take over. It's very simple.
Okay, Dr. Sambarak, what are your thoughts about inflation? I know you're up in Canada. I guess you're feeling the effects of the inflation here.
Well, first of all, I'd like to say that I've heard it, that if you laid all the economists in the world end to end, they still would not reach a conclusion. So having said that, I want to ask Professor Posen the following question. The biggest beneficiaries of inflation are borrowers. And the biggest borrower on the planet is the United States. What motivation do they have to control inflation when it is of such a huge benefit to all borrowers? I don't see inflation under control because there's not much motivation for that.
Well, I agree that the U.S. is one of the, if not the biggest borrower, but I think the political implications of inflation are very negative. If people, as they are now, going at the gas tank and paying over $5 a gallon, if the price of food is going up, if the price of housing is going up, so that even though their wages are going up, their buying power is decreased, that will lead to even more pressures. So in the U.S., we've had, as in a large part of the world, low inflation expectations for the last 20 years. But now consumers are starting to expect inflation of 3 or 4%. And the Fed really has to take aggressive action to get those inflation expectations back in line. So I think that although the U.S. as a borrower benefits from inflation, I think that the bigger concern is on what happens to consumers and the political implications of that. Lastly, I'll say even the U.S. as a borrower, if nominal rates go up, then they're going to have to start paying a lot more on their short-term debt. The average maturity of the U.S. debt isn't that long, and so it would start to have a big budgetary effect too. I have no doubt that the Fed's view is whatever the benefits of inflation for the U.S. as a borrower, they're going to want to bring consumer expectations back toward 2%, where it has been for many years, but that's changed dramatically in the last 6 months.
Yeah. Okay, we'll go to Peter.
It sounds to me like you're an economist who has reached the conclusion. So congratulations on that. Personally, I am a borrower because the market is a bargain. And borrowing money, even at today's rates, to buy the U.S. economy by purchasing an exchange-traded fund which tracks the S&P 500 is a bargain that we haven't seen for a very long time.
But Milan, what you have at the moment is a situation where you have high rates of inflation and a contracting economy. So, yes, the money might be cheap right now, but the economy is contracting in the US. We're talking about potential recessions. Consumer spending is at the lowest levels in a couple of decades. Let's just go back before COVID. 4 or 5 years ago, countries like Australia, the US, the UK, most of Europe were all complaining that they couldn't get inflation above 2%. That was their target rate. They couldn't get there. Now it's at 8%, 8.5%, and higher in some parts of the world. So what you're saying is that people aren't spending as much because they can't afford to. The economy is contracting and money's cheap. Something has to give, in my opinion.
Okay, we'll go to Peter Bennett. What are your thoughts about this
I
inflation?
have a totally different take. I wouldn't touch the
I figured you would.
S&P. I wouldn't touch the S&P 500 right now for anything. The markets, are forecasting percentages, like Bob, maybe we're correct. Maybe it's 50-50, but I'm going to go out on a limb, and I was right about a lot of things like energy I've been talking about for a year, and the markets I've been talking about for 6 months on modern investing. But I would say it's almost certain we're going to go into recession, first of all. And if we don't go into recession, it's going to be a very long and painful period of very slow growth, which is effectively going to affect the stock market and consumers the same way. Why do I say that? Two different takes. One, this is just an article I came across today, which I wasn't even going to, I'll make my point of what I think, but they list 16 different reasons why we're going into recession. Some of them have been mentioned already: Ukraine, inflation, but they also say demand pull from the massive stimulus is concluding. Consumer sentiment is at near historic lows. The Chinese housing prices are declining, and there's COVID lockdowns. Companies have inventory overstocks. Executives overwhelmingly expect a recession, so they're going to make their plans based on that. There's also the wealth effect, and there's been a debate for years over whether the recessions start the stock market down or the stock market down causes the recession itself because people have less money to spend. But now I'm going to give you my take. The Fed has totally lost control of inflation, and they have no chance of recovering from what they've done in terms of overstimulation, as Bob said. And there's at least 3 reasons why they can't do anything about this. 1, energy, which I'm going to get into in a minute. 2, rents. Rents follow housing prices by 6 to 18 months. Last year, rents went up 20%. Rents are still going up. And then you have the wage spike price spiral. Just today, just in the news today, the airports are having huge delays and many canceled flights because they don't have enough workers. Amazon is saying that they may have to slow down their deliveries, and they are short of workers. And people get into a psychology of, I need big raises, and it's a tight labor market. So, but the key is energy. If you look at energy, and I have 2 charts. One, this is a chart of since 1968, and I highlighted 2 periods, and those 2 periods showed 8 and 10-year periods of increases in energy prices. Now, there's another chart, and this is a chart of a long-term chart, but the highlight is if you look at where, there you go, right there, we've only started a period of high energy prices since December. So this could go on for 6 to 8 years, 10 years of hugely increasing energy. Now, why do I argue that it has to happen? USAC, one of our investments that we talk about on the show sometimes, said last year that the energy companies are putting in 40% to less capital expenditures to just maintain where oil is. We're not talking about increasing it to meet demand, just to maintain. They're putting in 40% too little capex. 2, Moody's just in the last month said that 57% more investment is required by the energy companies to satisfy world demand. And I just saw that the energy companies are putting in 23% less capital expenditures than they were before COVID. And demand is already up for energy, and it's going to go higher as things recover. So why is this not going to happen? One, hostile regulations. The Biden administration, I mean, it's on the record. They've done so many things to stifle energy. And you know what, as a footnote, if they want to decarbonize the world, they're not doing the right thing, because carbon in the world went up last year, and carbon emissions in the United States went up last year because, and I could get into that too, but the bottom line is they're increasing demand for coal and natural gas because by stifling everything. So number two, ESG spending. Oil companies spend 10% of their budgets on decarbonization. And three, they are in potentially terminal businesses. The BP rapid transition, which talks about if we go to renewables quickly, shows oil being used in 2050 maybe at 30% of what it is today. So if you're in an oil business, you're going, wait a minute, we're not going to keep over investing as we have before, creating cycles when we want to return money to our shareholders. And so we're going to start returning money to shareholders, which is fair if you're in a business, to make some returns, unlike, by the way, they were making in years. So for all these reasons, the oil companies are not going to expand much. They will spend more, but they won't spend enough to meet demand. So we could be talking about a 5 or 10-year period of increasing energy prices, and it's going to stifle the economy, and we're in a period of change.
Peter, have the oil companies ever been more profitable than they are right now?
Well, you know what? They took huge losses for many years. So they, yes, they're making money now, and they lost money for many years. But they're not, I don't even understand the question. I mean, they're going to spend some more money on capital expenditures. But look, if you were told your business is going to be shrinking in 10 or 15 years, you'd say, well, I'm not going to keep expanding it forever. We're going to go through a period where they're going to spend less because they want to increase their dividends or buy back shares. And by the way, as a footnote to that, Milan, the oil companies can make a lot more by reinvesting in their own shares now because they're so undervalued rather than expanding. So they have a huge incentive to take their money and just buy back shares instead of digging, oil, looking for oil. And I'll add that the average major development takes 7 years from start to finish for an oil field to be developed. This is not like, okay, we're just going to turn around the spigot. Some of the major fields took 30 years to hit maximum capacity. This is not a quick moving business. So all the incentives are on the side of, let's be cautious, in this environment, in the regulatory environment, in the ESG and they're just not going to spend the money. And they're not. And the evidence shows it, because if you look at the actual growth in the United States of energy, even with these high prices in the last year, it's not that much. The supply has not increased that much. And that's not even counting the Biden, decreases, but, of the effects of some of that. But I'm just saying you're not seeing big increases around the world in energy production, and you won't. And that doesn't even throw in Ukraine and all the other issues.
May I have a question? Bob, a question to you. Based on what Peter just presented, the major question that I have is so-called theory of efficient markets. Now, the inflation with us is for now several months, if no longer. The higher oil prices and gas prices is there for several months now. The stock went down, say on average, from 20% to some stocks went down as much as 60 and 75% just as well. Does that mean, and would you agree that market as being efficient already factored in all this news, or it's take them as just they happen and only then adjust its prices? What's your opinion?
Well, I agree with Peter that U.S. energy companies are not reinvesting at the rate they were before, and it's a rational response. All the fracking companies were losing money. Investors gave them a really hard time about it. But there are sources of new energy outside the United States, such as the Mediterranean, where Israel is now bringing online with Egypt a big amount. And you have places like Saudi Arabia that could increase their energy production in the short term. Whether they will politically, it's another thing. Now, to answer your question, uh, I think the markets have adjusted somewhat, and so they're efficient because there's a time of great uncertainty. So when interest rates, the one thing that's certain is interest rates are going up, and that means that the discounted cash flow uh, calculations are really different. And you had all these companies with revenue without uh, short-term earnings, and they were looking for earnings over a longer period, and so those prices have adjusted, and you see lots of tech companies without that didn't have real strong earnings down 30, 40, 50%. And then you see the market in general adjusting to the fact that there are probably going to be uh, lower earnings as we see consumers having to spend more on energy. Energy companies are really the only ones that are really doing well in this market. So I think the markets have so far responded efficiently, but they haven't gone further because they're waiting to see what's going to happen here. And I think as we see how aggressive the Fed's going to be and how the economy is going to respond to that, we'll see more adjustments. But I think the big difference now is that in the past, when we've had recessions like we had with the pandemic or we had in earlier times, the Fed had lots of room to respond. They could cut rates and they could introduce more liquidity, but that's not feasible in this case. So that's why I think the chances of recession are quite significant because the Fed doesn't have the tools that it used to have in other situations.
Can I just address something about these supercharged profits that's being attributed to the energy companies? You know, they're not in charge of worldwide oil prices. Of course, their gross profits are going to be a little bit higher. They're not reinvesting those profits into new wells because of the policies of the Biden administration.
Yeah.
So what are they doing? They're using that money to pay down debt and to make investments elsewhere. What are they supposed to do? The idea that they are supposed to discount their profits, you know, after they've come out of a period. Let's remember 2020, we actually saw oil in some parts negative because there was nowhere to store the oil. Nobody complains when the oil companies are losing money. Gas prices have many times over the last couple of decades gone negative. Nobody says anything to them then. But when they try to make up for that during a time of high demand and high prices, all of a sudden they are the horrible gremlins that are sucking out profits at the expense of everyday people. Now, if you look at some of the big tech companies like Google and especially Apple, Apple's made substantially more profit than what ExxonMobil's made. Does anybody suggest that Apple is price gouging the market? They're fully in control of the price of their products, but nobody suggests that. But in this case, we're all going to complain that oil companies are taking advantage. I think that that's very, very unfair. And I think that that fundamentally misunderstands the motivations of companies. I'll just add that if they were to introduce price control, something that I'm so against that I think history shows does not work, you're going to end up with shortages. And that's what we've just seen here in Australia. Here we are, a first world country that generates our own oil. We generate our own electricity here. We are a coal exporting country, so a lot of our energy is created with coal. And yet we've got blackouts across the eastern seaboard of Australia because the national energy market artificially capped prices. And when there's an uptick in energy prices, the suppliers just basically shut down rather than selling these things at a loss. That's what happens try to artificially cap a market.
United States is the biggest user of energy. The biggest store of oil on the planet is Canada's oil sands, and Biden just stopped the Keystone Pipeline transition. Now, the United States has become energy independent recently since the introduction of fracking, but European countries certainly depend now on Russia, and the ignoring Canada's oil sands might be a mistake. I'd like to hear what you have to say about that.
I think it's 100%
put back into.
Well, actually, the oil sands are extremely carbon polluters. You know, it's a really, but I'm not saying one way or the other because we have a huge energy shortage. So, you know, and you know, so you have different sources of energy that are available, but and I think the sands will continue to be used because they're going to build pipelines to the west coast of Canada, and whether we use it or somebody else does, it's a world market. I will also mention that, you know, for instance, that Mediterranean project that's coming on in Israel, that is in the water. So it costs a lot more to get energy out of the ocean, much more expensive than getting it on a land base. So that alone raises costs.
Okay, we've been now joined by the
not only is it curtailing supply, but you also have a lack of refining capability. So if you don't have anywhere to refine the oil, and that's where CapEx is really going to play a big part. If companies are being hammered by the media and criticized by government, the investors are not going to want to invest in them in the first place. And so that lack of investment means a lack of oil refining capacity. This is going to last a long time unless there's a substantial change in policy, not just in the US, but in the international community.
Okay, we're going to be now joined by the Honorable David M. Walker, the former Comptroller General of the United States of America. David, welcome to the show. Good to have you here.
Thanks. Good to see you again, Bob.
The economy, of course.
Good to see you, David. It's been a while. We both fought the good fight on Social Security, but so far we haven't won that fight.
Not even close.
We're still
I
fighting.
don't know if you're even close.
Still fighting. Yeah.
Bob manages to triple investments in private enterprise, manages to go from 500 billion in Fidelity to just under $1 trillion, and Social Security has gone the other way. They're out of money. I think that says a lot.
Well, we're discussing, to start with, David, inflation. Okay, so we'll start at the beginning of inflation. What are your thoughts about this thing that we're going down the rabbit hole, otherwise known as inflation?
Well, first, I think the modern monetary theory has been a disaster, and the people who advocated it, were progressives. The leading advocate was the chief economic policy advisor for Bernie Sanders, which was one of the reasons that Bernie never answered the question of how much is this going to cost. And just to refresh your memory, the theory was, deficits and debt don't matter as long as you can borrow in your own reserve currency, unless and until you have excess inflation. Now, the problem with that is as Bob and others would know, it's contrary to long-established economic principles. It's contrary to history. It's based upon a flawed comparison to Japan. And guess what? We now have excess inflation. And so I think people in Congress tried to embrace the modern monetary theory while we had low interest rates. There was excessive spending, some of which of that spending was justified because of COVID. Some of it was not. We had very loose monetary policy. The Fed was way behind the curve with regard to interest rates. The Fed was buying almost all the new debt. Therefore, we didn't really have market-based interest rates. Energy policy did a 180. We went from being drill baby drill and let's be energy independent, not just to help us, but to help our allies so they wouldn't be as dependent upon Russia and other negative players like Iran, Venezuela, et cetera, to where now we're having to go and try to get other people to do more because we're not willing to do more. And by the way, you just can't turn a spigot. I mean, people are making decisions that they're looking for some degree of certainty and stability years in advance in order to get additional rate of return, just as the stock market is looking 6 to 9 months in advance as to what they think things going to be like in 6 to 9 months. We do have supply chain challenges. There's absolutely no question about that, and a lot of that is attributable to others. And Ukraine has exacerbated the issue. There's no question. But the idea that Putin caused all of this is, let's just say, not realistic. And so we'll see. I mean, I think there are things that we can and should do in order to try to deal with it. The question is, will the administration do it? And the big first thing is energy policy. And what, if anything, are they willing to do with regard to energy policy? And it's not clear to me they're willing to do anything other than to jawbone the oil companies.
Can I just ask this question, though? We talk a lot about supply chain disruption, supply chain issues. There's been an increase in costs, mostly because energy costs and oil costs have gone up. But other than that, why is there why is there a supply chain crisis in the world? Why?
Well,
what's the problem? And the reality is, it's government intervention that's caused this. It's not just a natural supply chain issue. This should have been resolved by now.
I don't think that.
Let's talk about several. Bob, go ahead. Go ahead, Bob. Go ahead. Go ahead.
I don't think that's fair. I think there are lots of supply chain problems that have grown out because of shipping problems, because of difficulties in labor markets of getting enough people. If you go now to try to have your house rehabbed, you can't get labor to do it, and you can't get parts. I had a situation where we did some rehab on our house and it took us a year to get parts, because I think these are very realistic problems. We have a chip shortage. And so I think there are lots of real supply problems that grow out of chip shortages, that grow out of scarce labor, and that grow out of shipping problems.
Right, and let's keep in mind that China had significant disruptions with regard to their shipping, in part because of the approach that they took with regard to COVID-19, especially with regard to Shanghai. And in fairness, if we look at Ukraine as an example, Ukraine's a major provider of wheat and sunflower oil and a variety of other things, and so that has been disrupted as a result of the war in Ukraine. It has more of an impact on other parts of the world than us, the Middle East and Africa, who rely upon their grain more than we do. But it's a global market, right? So, and for a while we were having difficulty getting truck drivers. But there's no question that energy prices are a big, or probably the major part of the cost factor. And yet, let's look. We've got more job openings now than we've ever had. The problem is there's a mismatch between what we need and the people that are looking for work.
Well, I have a question for Bob and for Dave, especially since we have two people who had worked so heavily on the Social Security issue. I have read, and there's disagreement on the numbers, but that the unfunded liabilities for the United States and the whole world, I always have to throw this in, is in a similar situation because they've promised free Medicare too. So it's just not the United States, but that the unfunded liabilities for the Medicare and these other programs, especially Medicare, are greater than the total amount of all privately held stocks, bonds, and real estate combined. And this could be hundreds of trillions of dollars. And, we just put it off for 2 years, the dates when, it's going to be in deficit. But we're not talking that long. I think it's 28 now and 34. But what is going to happen? Because, for not only my show, but for me as an investor, I keep thinking, what happens to the economy when all this money has to be printed? Maybe yield curve control down to zero. But what happens? What do you think?
Well, first, let's talk about the numbers. the latest financial statements, which are as of September 30, 2021, the numbers that they use for unfunded obligations for Social Security and Medicare are as of January 1, 2021. And in those financial statements, the unfunded obligation based upon a 75-year horizon, which is what the law calls for, which is what the trustees use, and I was a trustee from 90 to 95 for Social Security and Medicare, were $70.1 trillion. And, you know, off the top of my head, I think they went up about $5 trillion in that 1 year. I got to take a look and see what the new numbers are based upon, based upon the latest trustees report that came out. Those would be numbers as of January 1, 2022. Look,
That's
we're
just
not
for that
going to let
program,
these
though, isn't it?
programs. We're not going to let these programs go insolvent. All right. I mean, that would be politically infeasible. You got to go back in history. In 1983 was the last time that we reformed Social Security. Do you know why we reformed it in 1983? Because, as Bob knows, within weeks, the trust fund, and I put that in quotes because it's not a real trust fund, it's an accounting device. The trust fund was going to go to zero. The modern day equivalent to that is 2034. And if it goes to zero, everybody's Social Security benefits get cut 22, 23% across the board. That is politically unacceptable. That's not going to happen. The question is, are they going to do something sooner rather than later? Medicare, there's a different impact. When Medicare hospital insurance goes to zero, and keep in mind, it's only the hospital insurance program. The other programs aren't funded the same way. They're primarily general revenue funding. The hospital insurance program, it's a 10 to 15% cut in providers, or a 10 to 15% increase in premiums, or some combination thereof. So, you know, people talk about the $30.5 trillion in debt. I talk about the total liabilities and unfunded obligations, or what I call is the birth burden. If you're born, how much of a load is being placed on you? It's 112.1 trillion, not 30.5. And of that 112.1, as of last September, 70.1 is Social Security and Medicare.
Wow.
David, I just want clarification. When you say they have to increase it by, I think you said what, 7%, or how much do they have to increase it?
No. The difference
The premiums.
between
If they wanted to increase them,
22% cut in benefits immediately
or
for Social Security.
What increase would they have to have in premiums? You said how much?
10 to 15. That's for Medicare Part A, which is hospital.
Right. But are you saying 10 to 15%, bringing the 7.7 or roughly increasing that by 10 to 15%? Or are you saying bringing the 7.7
That's
to 20%?
just the balanced cash flows.
Right.
It gets progressively worse for two reasons: known demographic trends and rising healthcare costs.
But what does what does that increase mean? In other words, when you say 10% or 15% increase, are you talking about bringing the rate to 20%, or are you talking about taking the 7.7% and bringing it to 9 or 10?
The Medicare Part A hospital insurance is funded largely with a payroll tax, 1.45% on individuals, 1.45% on employers, no cap. There's no cap on it anymore. All right. And so what I'm saying is that has to go up, or either the payments that you make to providers.
Right.
There's a 10 to 15% gap. So you either have to increase the tax by 10 to 15%, or you have to cut the payments to providers by 10 to 15%, or you have to do some combination thereof.
Right.
So to achieve balance in 1 year.
I'm just trying to drill down on that 10 to 15% to understand it, because that's a big difference. Are you saying let's say it's 10% as an example. Are you saying the 7.7 has to go to about 8.7, or are you saying the 7.7 has to go to about 17%?
No, the 1.45 has got to go up 10 to 15% for both the individual and the employer.
But David, wouldn't it be better to address this, have our politicians address it now actuarially, than to wait till it's a crisis?
Well, Nick, David and I were involved in 2005 and 2006 in trying to come up with what was called progressive indexing, which was to protect the lower third of Social Security benefits and to slow the growth of the higher third, and we couldn't get anywhere. And that was a progressive solution, and it also would have changed modestly the cap on Social Security taxes. So there was at that time a possible solution, but it but we were attacked as being benefit cutters. We weren't really benefit cutters. We were slowing the growth of benefits for the higher earners.
Hmm.
And unfortunately, since it wasn't done at that time, the numbers are much worse now. And this answers your question, Peter. I don't think we'll have an increase in payroll taxes on Medicare or a decrease in amounts that go to providers. What we're going to have is appropriations. Congress is going to
Spending.
appropriate the difference. And when we were having low inflation and low interest rates, that didn't seem like such a big problem. But now it is looking like a much bigger problem, since I believe, David, I think would agree, that Congress is not capable of uh, acting in a decisive manner until we get very close to the shortfall where the system would explode. And at that point, uh, Congress then will appropriate the difference. They might make modest changes in the program, but they're much more likely to sort of essentially bail out the programs uh, by appropriations, and that in Medicare, and that's the same thing that's going to happen in Social Security. Unfortunately, we're now in a situation where we're issuing a lot of debt, and we're also having high interest rates. So the timing is most unfortunate. We could have done something, we didn't. So that makes it even more important to get uh, inflation under control in the next 2 years, so that we're not in the situation in 2028 of having high interest rates.
Yeah, I think we have to keep in mind
Tuesday
too.
appropriations.
I think we have to keep in mind that Social Security benefits are indexed. They're
Right.
indexed to inflation. All
Yeah.
right. And so when you look at next year's report, I expect it not to be as rosy as this year's report. Okay.
Right.
Let me mention a couple of things here. In 2012, Ross Perot largely funded a 10,000 mile, 27 state national fiscal responsibility bus tour that I led. And a key part of that is Alice Rivlin, may God rest her soul, and I had a couple of really key events where we addressed demographically representative groups of voters in swing states in the North and the South about our fiscal challenges, including Social Security and Medicare, including taxes and a variety of other things. And we achieved 77 to 97% agreement on what needs to be done to get debt to GDP down to a reasonable, sustainable level by 2035. And on Social Security, here's the reforms that people agreed to. They agreed to gradually increase the normal retirement age another 2 years over 20 years because of longer life expectancies. All right. They agreed to not increase the payroll tax because that's very regressive, but to basically double the taxable wage-based cap, but not eliminate it, to get back to the percentage level that it was when Reagan and Tip O'Neill agreed on reforms in '83, to increase the replacement ratio of benefits for people near the poverty level, to somewhat decrease it for upper middle income and upper income individuals, but not to turn it into a welfare program, and to take a look at the indexing formula for inflation for seniors because their purchasing basket is different than for everybody else. Those are the kind of changes that achieve supermajority support. But I think the only way that we're going to end up getting reforms before you get close to the trust fund going to zero is if we have a special commission. And I advocate for two things to get our finances in order: a constitutional amendment for debt to GDP, and secondly, a statutory fiscal sustainability commission that will engage the American people with the facts, the truth, the tough choices, solicit input, make recommendations. This is not just for Social Security and Medicare, it's for the broader perspective that will be guaranteed a vote in Congress. Because the truth is, The longer we wait, the bigger changes, the more risk of a crisis, and it's not in our interest when you know you got a large growing problem to delay it any longer.
You know, I would like to say something because I've been
Sorry, guys,
struggling
I'm
with
going to have to go. We've just had another power outage, so hopefully I'll see you guys on the next show. But
Right,
no
we'll see you.
power here in Australia.
Yeah, I lost you too, so I'm going to try to find
well,
you.
I'd like to say I've struggled with what would happen about this for like 10 years now, 5 years, in terms of the investing perspective. You know, what will happen to the markets because of this? And thanks to Bob and Dave, at least I think, nobody can know, I have a theory now on what's going to happen, which is because, first of all, Bob and Dave said the same thing in a way. Bob had a very good point. Congress will wait till there's a catastrophic situation to the last minute. And David added that it's regressive tax. So that's even less likely that Congress is going to do anything. So now we get to 2028, which is not that far off anymore. And all of a sudden now this program goes into deficit. So what happens? Bottom line, money printing, which is what I thought was going to happen. At that point, you're going to get another reason for high inflation. And also, something that I mentioned a lot before in my, in the show and other times is yield curve control. So what happened in Japan and the United States did this in the 1940s when they were printing money, I guess, for the war, is they controlled the interest rate. So during the war, they said, we are going to not allow interest rates to go over 2.5%. So then what happened is the market got used to it. And it said basically they didn't even have to do a lot of work to maintain it at 2.5 because the market knew that 2.5 was the cap. So and Japan did this for a while, and we're doing it effectively for a long time, stimulating the economy. So when there's so much money printing, rates are probably going to head towards zero, which I will add one last footnote on that is if you look at the path of the Treasury for the last 10-year Treasury or 30-year Treasury for the last 30 or 40 years, it's almost a straight line towards zero in about 6 to 8 years. So it all correlates. So from an investment perspective, I think I understand what's going to happen. And we are going to have inflation, and we are going to have probably very low interest rates.
There's a very important approach to healthcare that nobody's paying much attention to, and that is lifestyle. Half the people who are in the hospital today are there because of their lifestyle. The United States spends 18% of GDP on healthcare, and it is way down on measurable criteria such as life expectancy. The United States spends 5% of its GDP on military activities, and it has a military presence in every country in the world, with a possible exception of North Korea. And so people ought to be taught how not to need healthcare. That could be cut down significantly if we focused on educating people. Under conditions of food abundance, all species, including Homo sapiens, increase the size of the populations, not the size of the waistlines. And the reason why we are increasing the size of our waistlines is because constantly tempted by advertising to buy into and to consume an irresistible combination of salt, fat, and sugar. And so education should lower the demand for healthcare. It certainly could. And in many individual lives, it does, because people exercise sensibly and eat sensibly. That's possible for every individual. Not enough individuals are embracing that approach.
Milan, thank you. I would like to mention something, that the only other area where there is much more advertising is visible on TV, especially if you take, for example, events like a Super Bowl event, for example. There is one area, it's a cryptocurrency. Cryptocurrency advertises way much more than any foods. And I would like to know, Bob, what do you think about cryptocurrency assets? Are they assets or different type of stocks, or how you treat them? What exactly it is?
Yeah.
I'm not sure I fully understand the question.
What asset class, or what do you consider cryptocurrencies to be? Are they an alternative asset class?
I think it's a speculative asset class where we don't really know what its value is. Hopefully, it will devise a regulatory framework for it that will make it uh, uh, safer for investors. Cryptocurrency has some advantages in terms of, for instance, international exchange of currencies, but it also has lots of problems. And we've seen, unfortunately, in the last few months, some of the most difficult problems that have occurred. So I don't know. I don't think it's ready to be a separate asset class until we have a better, firmer regulatory structure for it.
Let me mention a couple of things about healthcare. This tour, we also talked to people about healthcare reforms, and some of the things that the public agreed to with over 80% included reforms like that we ought to have universal healthcare for basic and essential services. Basic and essential really means two things: preventative and wellness, and catastrophic care. The idea that it's in our broad-based societal interest, which includes the education comment, to have preventative and wellness, because in the labor force you have turnover, and it takes it takes a while before you recover the benefit of that investment. But from a societal standpoint, there's a need for it. And secondly, catastrophic. The one thing that everybody needs, although depending on your income and wealth, it varies, is protection against financial ruin due to unexpected catastrophic accident or illness. It's the number one cause of bankruptcy.
Yeah.
What the government tries to do is it tries to promise too much to way too many and to subsidize too many. And that is unsustainable. The other thing is one of the big debates right now is on prescription drugs. We pay way more than the rest of the world on prescription drugs. And part of the reason being is because we disproportionately fund research and development for prescription drugs globally. Many countries have price controls. We don't have price controls. I'm not advocating for that. But I do believe that we should do two things, and the public supported it by over 80%. Number one, you can't advertise prescription drugs. It fuels demand. Most of the major industrialized nations don't do that. You don't have it. And secondly, the federal government shouldn't price control prescription drugs, but it should have the right to negotiate prices over prescription drugs. There's only one federal agency that has the ability to negotiate prices over prescription drugs right now, and that's the VA. But the ones that spend the most money, like HHS, they don't. And that's different than setting prices, but it does have an impact on controlling, holding them down.
Right. And then we're at the hour. So the thing is, I do want to thank the Honorable David M. Walker, former Comptroller General of the United States, Sasha Starr from the IBM TV Modern Investing, Bob Posen, who's the professor at MIT Sloan School of Business, Peter Bennett, also with Modern Investing in Milan, someone with Modern Investing. We'll see you next week on Economics with the Honorable David M. Walker. In the meantime, hold on to your pocketbook because it looks like we're going to be in for a wild ride.
Can I just end by saying that I think David Walker, both on Social Security and on prescription drugs, has great ideas, and it's too bad that they're not being adopted.
Yep. Yeah,
Thank you, Bob. Good to see you again.
Bob, we're gonna keep pushing those ideas through our network, and thank you all our walkers.
2028 they'll adopt them.
All right, we'll see you then. Take care. Bye bye.
Bye bye.